In the dynamic world of cryptocurrency, decentralized exchanges, or DEXs, are constantly evolving to offer more than just simple spot trading. In this video, we'll be talking about the top perpetual DEXs. Perpetuals are simply a type of futures contract with no expiry date, whose design allows for trading of cryptocurrencies with leverage. Leverage can both amplify potential profits and losses, so manage your risk accordingly. First up, we have the most dominant perpetual DEX, DYDX. It offers up to 10x leverage on most assets, with 20x available on select pairs like ETH/USD and BTC/USD, and charges a fee of up to 0.5% on trades. Unlike many decentralized platforms that use the automated market maker or AMM model, DYDX opts for the order book method, common in centralized exchanges, as the team believes it's more efficient. DYDX's order book combines both on-chain and off-chain methods to match trades accurately. The protocol incentivizes users through its native DYDX token. Liquidity providers are rewarded with 5.2% of the total token supply, while active traders on the protocol are allocated 14.5%. In June 2022, DYDX revealed plans to move from StarkX, an Ethereum Layer 2 solution, to its own standalone chain in the Cosmos ecosystem by the end of September 2023, citing the need to further decentralize and scale. Next up, we have GMX, which is built on Arbitrum and Avalanche. GMX allows perpetual contract trading with up to 50x leverage on all available pairs and charges a 0.1% fee on trades. The DEX works using multi-asset pools, which allow users to provide liquidity in exchange for GLP tokens. They are then rewarded with 70% of the protocol's revenue generated from the fees paid by the users every time they make a transaction. Additionally, they receive SGMX, short for Escrow GMX, which can be staked for rewards or be converted to the protocol's native GMX tokens through vesting. However, it's worth noting that GLP holders, who are the liquidity providers, are essentially in a counterparty relationship with traders. This means that if traders on GMX are winning, GLP holders lose out, as trader profits are paid out from the liquidity pool. There's also the GMX token, which gives holders voting power and 30% of trading fees generated from the platform in the form of ETH or AVAX, depending on which chain you're using GMX on. GMX rolled out its Beta V2 in August 2023, which introduces new features such as new markets, multi-collateral types, faster trade execution, and reduced fees. Moving on, we have gTrade, a product of Gains Network that operates on both the Polygon and Arbitrum network. The DEX offers high leverage of up to 150x for cryptocurrencies and charges a 0.08% fee on trade. For liquidity provision, users deposit DAI into the gDAI vault to receive gDAI tokens, which allows them to earn a piece of the trading fees. Winning traders receive their gains from this vault, while the losing side's losses funnel back into it to grow the vault. On top of gDAI, the DEX has a utility token known as GNS. The token is meant to enhance the DAI vault's stability and offers inflation protection, plus will serve as the protocol's governance token in the future. Next up, we have Kwenta, powered by the Synthetics protocol. As you may already know, Synthetics is a protocol on Ethereum that creates synths, which are synthetic assets on the blockchain that mirror the value of other assets, mainly various cryptocurrencies, but also commodities like gold, silver, and even fiat currencies. Kwenta enables up to 25x leverage on most pairs and up to 50x on select pairs, like BTC/USD, ETH/USD, and USDT/USD. The SUSD token, central to these pairs, is a synthetic USD token issued by the Synthetics protocol, but instead of being backed by actual dollars, it's collateralized by SNX tokens. This ensures that Kwenta has liquidity, as it draws from SNX token holders staking on Synthetics. Kwenta charges a 0.02% or 0.06% fee on trades and has its own native token known as Kwenta, which can be staked to earn rewards and voting power. Up next is Level Finance, which is built on the BNB chain and Arbitrum. The DEX currently lets users enter trades with leverage of up to 50x on BTC, ETH, or ARB, and charges a 0.1% fee. Its liquidity model is similar to GMX's, except that it separates its liquidity pools into tranches depending on the level of risk to the traders. LLP tokens are given to users who provide liquidity to the platform, which grants holders 45% of the protocol fee revenue. Unlike GMX, however, Level uses a dual token model to separate utility and governance functions within the protocol. LVL is the utility token, which can be staked to earn platform revenue and also earn LGO, the governance token, which can be used to vote in the Level DAO. Last but not least, we have Perpetual Protocol, a DEX on Optimism that allows traders to leverage their positions up to 10x and charges a 0.1% fee on trades. Perpetual Protocol introduces its own version of the AMM, known as the Virtual Automated Market Maker. It's virtual in that, unlike traditional AMMs used by Uniswap and Balancer, which depend on users depositing assets into liquidity pools, no real assets are stored on Perpetual Protocol's VAMM, which is designed primarily for price discovery and not direct asset exchange. Instead, assets are stored in a smart contract vault, which then acts as the collateral backing the VAMM. Perpetual Protocol has established measures, including an insurance fund, to manage the risks associated with traders being unable to cover their leveraged trades. The trading fees within the protocol are currently distributed, with 20% allocated to the insurance fund and 80% going to market makers. The protocol also incentivizes user participation via its native token Perp. By locking their Perp, users can become eligible for weekly USDC rewards. There you have it. Those were some of the most popular perpetual DEXs currently on the market. Be sure to check out this video where we discuss other types of crypto derivatives.